Hello everyone and welcome into the channel. My name is Brent and in today's video we are going to be doing the M1 Finance Dividend Portfolio update. We like to do these every week because we created this portfolio 5 years ago on this channel with $0. So on a weekly basis we like to go over a few areas. Number one, the holdings in the portfolio as well as the overall performance. Number two, the weekly performance on a week-to-week basis. What companies were positive? What companies were negative? How did our portfolio compare to the indexes such as the S&P 500, the Dow Jones, NASDAQ? Number three, we go over any sort of weekly activity that came in as far as our buys, our sells, any dividends that came in, as these can be ideas for other investors out there saying, hey, what sort of dividends pay out in the month of March? These are a few that are paying out in the month of March that you could be invested in. So the next time they go through an X dividend, you could collect on these as well. And then overall, we'll do a quick breakdown of our overall dividend portfolio income for 2023 going forward. So with that said, if you guys are brand new here to the channel, definitely go down below, hit the subscribe button, and definitely hit the bell to get notified when we make a new video. So with that said, let's go ahead and get into it. So really quickly, right now, I've been watching this here on the meter here, and throughout the weekend that I was watching this thing has gone from extreme fear up to fear, down to extreme fear, with everything from increasing inflation, rates continuing to rise as far as rates. Fed's supposed to raise rates 0.25% because they're kind of pigeonholed. Are they going to be raising rates? Are they going to be no longer raising rates to zero, showing signs that, hey, this banking thing is more of a problem than what people are letting on? Or are they going to keep that rate increase at 0.25 because our main thing to combat here is inflation? So we don't want to show signs that the banking system's cracking. So we want to keep pushing towards the narrative that inflation is under control by increasing rates of 0.25 to 0.5%. So there is a lot of extreme fear in the market, and as we've said, there's a whole lot of uncertainty coming forward in March, and that has continued to be the headline day after day here so far in March. So extreme fear is kind of going on. We can see futures right now pre-market. So if we select pre-market here, so right now I'm recording, it's about 5 hours away. I'm about to go to sleep here and wake up in the morning, probably see a lot of red here as we see pre-market. Dow Jones down 0.79, S&P down 0.66, NASDAQ down 0.42. So that's kind of where we're going into the Monday morning. So let's start off with number one. How has our portfolio been doing this past week? So overall, we are still up, net positive 42.10%. So overall, we're doing pretty positive out there. I know there's a lot of up and downs that we have been through. Starting back in 2018, we started this portfolio with $0 on January 8th, 2018, and invested there. And there was a bit of a dip here initially when we invested. We dropped about $400, but hey, we chugged on through it. Continued to dollar cost average, went through that really quick pullback here in February 2022, all the way down to, $14,000 at the time from a high of 21. So that was nearly half the portfolio seemed to almost vanish there very quickly, but it recovered, continued chugging along. There was some little hiccups along the way, more hiccups along the way, but here we are in 2023. You can see that there's even here along the way, over the past 1 year, there has been a lot of ups and downs, but along the way, we're continuing to collect dividends. Our portfolio is having green and red. It's kind of mixed and matched in there, but overall, it's doing well. Our best performers continues to be Apple, followed right behind by AbbVie, Lockheed Martin. So these are in the triple gain digits, but they go back and forth. I think last time we did a video, Main Street Capital had been in the 100+% gain, along with a few others, I believe. But, over the past 2 weeks, we've had a lot of anything that is sort of financially touched, such as real estate, BDCs, banks. They have just done a nosedive, a lot of them. Our worst positions in the portfolio, innovative industrial properties. I keep telling myself I don't want to really sell it because then I'd lock in that loss of $1,000. But at the same time, I don't really believe that this company in the future will recover um, because of the industry that they're in, the MJ industry. They're having a lot of issues as far as regulation, with MJ becoming cheaper and easier to get, and more people kind of popping up shops. And again, it's getting easier and easier and easier, and it's getting cheaper and cheaper and cheaper. So it's really hard to make that money back with how much they invested into it. Digital Realty Trust. This is kind of an interesting one to see that it's down still so much here. 48% Essex Property Trust. So as you can tell here, these are all REITs. REIT. Just bottom of the barrel here. Clorox has picked up quite a bit. It was down at 50%. So it's definitely been picking it up. Hormel Foods, Colgate, Waste Management are our only red positions. I continue to have faith in Waste Management. Colgate's one of those name brand companies. Hormel Foods, I don't know if I made the correct bet on that one as far as where I believe that their company would be going in the future. They did a reverse march and just continued the reverse march in place and kind of flip flop. Clorox, I don't think they're in a bad positions. I think I just kind of bought them at a very overpriced position during the end of the 2020 thing that took place where everybody rushed to buy disinfectant. So I just bought it at a really bad time and it continued to go down. But going forward, they're going to continue to pay a dividend. I can definitely dollar cost average, and long term, I don't believe Clorox has any issues. So that is the overall performance of the portfolio. Now, jumping to the weekly performance, we can see that we are negative. Now, we'll go ahead and cover our portfolio really quickly, and then we'll take our portfolio and compare it to the indexes because they definitely overdid us here. So our best performers this week, Apple up a whopping 4.38%. So they don't care anything about financials that are going on. Banks could be failing. Apple's just going to be chugging along, 4.38%. Cisco right behind them, up 3.36. AbbVie, so any healthcare pharmaceuticals, they've been kind of lagging behind this year. But if you are invested in any sort of healthcare pharmaceuticals right now, they seem to be kind of warming up and popping. So Johnson & Johnson, Pfizer, AbbVie, a couple of those companies out there. This could be a really good time to add to those positions if they're kind of beat up here. As you know, I think a lot of investors are kind of moving their cash that way as far as oil, healthcare, and they're going to wait a bit on financials to kind of find out where a bottom's at. So there was quite a bit of green, right? You can see Apple, Cisco, AbbVie, Clorox, Waste Management, Pfizer, Main Street, Colgate, Johnson & Johnson, Lowe's, IIPR, another little positive week. But we do have quite a bit of red, and our red was pretty red, right? We had JP Morgan, financials down 6%. I have seen that liquidity is an issue. A lot of these companies like JP Morgan, Citibank, Bank of America, Goldman Sachs, what's the other one? Wells Fargo. There is a lot of layoffs taking place, and there is a lot of individuals out there beginning to withdraw their deposits out of the smaller financial institutions. And you got these larger financial institutions kind of calling people up saying, hey, do you have any money to move over to us? So JP Morgan, while it is down 6% on the week, I think that them with many other bigger financial institutions, they're in a pretty good position right now moving forward. Sticky Selective, I don't know why this was down as much as it is. Maybe I honestly don't know. If I had down 5.26%, I don't know. It's okay overall. Merck, 2.67. This one's interesting to me just because this is in the healthcare sector. So down 2.67, whereas the rest of the healthcare is positive. Kind of interesting to kind of see, what went on with Merck versus the other ones that kind of dragged it down. But all the other ones, it's 50-50 out there. So overall, I'm really surprised that I'm down, or I'm going to call this flat, right? Down 0.4%, essentially flat on the week. We had 50 up, 50 down. S&P 500 put on a 1.43% gain. So completely blew my performance out of the water. Year to date, they're up 2.01%. I really wish I could do like a year to date on mine. I haven't added any equity into the portfolio this year. So yeah, 2023, we're at 0. So essentially I can go back and look at my video back on 2023 right here. I think it was like the first day of 2023 or so, and just kind of do a comparison of where I was and where I am now, and just do that yield, the difference there to kind of find it out. Not important right now. And then the Dow Jones. Dow Jones down 0.15%. So my portfolio is generally meant to kind of have growth and stability. So it is actually fell a little bit further down to the Dow Jones, but overall not too much. Again, I'm just kind of flat. So, I feel like it's okay. NASDAQ will up a whopping 4.41%. Look at that return year to date right now for the NASDAQ, up a whopping 11.12%. So they are definitely the winner right now year to date, followed right behind by the S&P 500, up 2.01. Then the Russell 2000 up down negative 2.01. And last place, we have the Dow Jones down 3.88%. So who will come out the victor at the very end of the year? That is still to be seen. So number 3, the activity. We haven't had any sort of buys and sells since the 1st of March, which I do believe that we covered in an earlier video. We completely sold out of Stanley Black & Decker. This is one that had been beat up in the portfolio. Yes, we did lock in those losses, and we transitioned the equity over to Waste Management, which isn't doing any better. But long-term wise, Stanley Black & Decker, I feel like their products just aren't going to be pushing like to the top of people's lists. Like if I'm just kind of thinking as a normal individual out there, like, hey, do I really want to spend a lot of my excess cash on these products that are going to take up even more of my money? Like the normal like Joe, right? The normal middle income individual, is he going to go out there and try and start a project, buy a bunch of tools, buy a bunch of items around the household to begin different projects right now when everything is skyrocketing high in prices? I don't believe so. So I still think that Stanley Black & Decker is on its kind of downtrend, where I don't know if it'll show very many signs of recovery. Dividends that came in over the past week, we have Pfizer, basically $15, Johnson & Johnson, $16.32, Main Street, $8.78, Avery, $7.44, another little tiny Main Street, 0.17, and Realty Income, $6.99. We'll call that $7. So you total all that up together, we got paid $62.33 over the past week, I believe. This is no, it's a 2-week period. Yeah, 2-week period. We collected $62.33 with no buys and sells since the very 1st of March. So that is where we are at. I don't have anything in mind. Our portfolio here, if we do a quick holdings here, we can see that this is our value is $44,559. Our portfolio value here, $44,558. So currently our portfolio yield is sitting, if you were to buy our portfolio at flat, you get roughly a 3.06% yield. Our yield on cost is 3.25, and our annual income is $1,363 for this portfolio. I'm not 100% sure if we're going to continue to fund this account. Right now, my main focus has been kind of adding equity into our taxable account. So I have been buying the S&P 500 SPY. I think I've added about 7 to 10 shares over the past few weeks. I'm continuing to write call options and using the equity to reinvest into SPY. I've begun buying a bit more of it around 380, lowered my cost basis on it. And if I could go back and start the M1 Finance portfolio over again, I would probably just start buying a bit of VTI. Yes, I'm thinking of VTI. If you were to start over initially with, buying into the market, I would probably start off with VTI first, because VTI, it's priced at $195.19. Buying your first 100 shares is only going to get you, only need about 19,519. And then once you have that 100 shares, you can begin looking at options. Plus, it tracks market gains and losses really close to the S&P 500. And then I would swap over to the S&P a little bit later on. This is one that's priced at $389.99 times 100. You can see this one does cost a little bit more to acquire 100 shares, but owning the S&P 500, you're able to write quite a bit more options, and this leads to having a lot more potential for extra equity outside of dividends. So I'd recommend that path instead of buying individual companies, which can open your portfolio to risk, where you're buying, for example, Tattooed Chef, right? Or Facebook or something that just dropped bottom of the barrel here over the past year. We can see here our 1 year performance. Amazon down 35%, Tesla down 35%, Disney down 32, Google down 23. A lot of investors jumping into the market over the past year thinking, hey, the market's going down, I'll buy now, the market will recover. Well, a lot of these individual companies are still down 1 year later. There's only a few companies out there. Check a look. 1 year from a year ago from today, how much green is actually out there in a specific sector? There's maybe a couple in the S&P 500. Exxon nearly 30%, whereas Chevron is down 3.4. Merck is up 33%, whereas Pfizer is down 24.23. So when you're adding into individual companies such as this, you have a high chance of saying, hey, I'm going to buy Google, I'm going to buy Amazon, I'm going to buy some Pfizer, I want to buy some Johnson & Johnson. I also want to have some financial, so I want to add some JP Morgan, Bank of America. We'll throw Apple and Microsoft in there as well. All of a sudden, you are beat up in the negative, down 15%, because you picked all these companies that were great at a time. They're going to be great long term, but in the short term, they just kind of get beat up. Whereas if you just kind of picked VTI in that one same year period, you'd be down roughly 13%. But it doesn't really matter what you had picked in that time frame. 1 year, right? 30%, 12%, or and probably another 12%. Yeah, 12%, right? By buying in the SPY, you don't really have to second guess yourself. Did I pick the best company for the next 5, 10 years, 20 years from now? Is that company going to, devaluate to zero? Whereas in the S&P 500, you buy this, it goes down, you feel comfortable buying it here. 70%, you're getting a 17% discount. It recovers here, boom, you're kind of, you continue to dollar cost average along the way, accumulate shares, and it just, it's easy. It's easy just to buy more. I don't have to think about if I'm buying it in a good opportunity or not, because when SPY is down, as it is down right now, I'm lowering my cost basis down. I'm collecting more shares. I'm going for 500 shares of SPY. I don't know if I will hit it this year, but I would love to hit SPY 500. Then I could write 5 call options on a weekly basis. I think I'm making about $500. That's how much I've made the past week on a weekly call with my options on SPY. Plus I made $100 on VTI twice. That's $700, I think. But VTI is a monthly option, so that's unfortunate. So that is going to be it for this video, guys. If you guys have any comments or questions, let me know down in the comment section below. I really do love to hear from everybody. So if you guys have any comments, questions, ideas for upcoming videos, let me know, and I will definitely get back to you guys. I do read and reply to all my comments. So that's it. I will see you guys in the next video. Bye-bye.